Picture this: red charts flashing, Wall Street traders screaming on the floor, and news anchors with faces pale as they announce another 1,000-point drop in the Dow Jones. One wrong move by the Federal Reserve, and it's not just a dip, it's a collapse. A collapse that could wipe out your savings, your retirement, and the future of global markets. And here's the kicker: that decision is coming soon. In the next 10 minutes, I'm going to show you exactly why the Fed is trapped, the 3 scenarios it faces, and the 3 signals you must watch to protect yourself. Stay until the end, because if you do, you'll walk away with a survival playbook that Wall Street insiders don't want you to know. The Fed's next move could break the market. Let's cut through the noise. The Federal Reserve has 2 official jobs: keep inflation under control and maintain maximum employment. But unofficially, it's become the firefighter, the babysitter, and sometimes the magician of global finance. The problem? The magic tricks are running out. Despite raising rates at the fastest pace in decades, inflation hasn't cleanly returned to target. Energy shocks, sticky service prices, and runaway government spending keep embers alive. Cut too early, and you pour fuel back on the flames. Hold too high for too long, and the real economy suffocates. Meanwhile, U.S. government debt looms like a mountain. Every tick higher in rates balloons the interest bill. Imagine carrying a $34 trillion credit card where the minimum payment grows bigger every year. That's America's math. Here's the trap: whatever the Fed does next, something breaks. Cut rates and Wall Street cheers for a week, but inflation can roar back, the dollar weakens, and foreign investors start fleeing. Hold steady, and the squeeze tightens. Layoffs creep up. Small businesses gasp for air. Credit markets crack. Hike again, and you risk detonating the bond market while Washington stares at an impossible debt spiral. That's why every hedge fund manager hangs on Jerome Powell's pauses and commas. Every emerging market central bank braces for impact, and you should too. But before I tell you the scenarios, here's a quick reminder. If you want breakdowns like this without the hype and panic headlines, hit subscribe right now, because each week we strip the drama down to the drivers that really move your money. So what are the roads ahead? Scenario 1, the Fed cuts. Mortgage rates dip, credit cards ease, growth stocks explode, the dollar weakens, and gold and silver shine. Crypto pumps, Twitter screams, bull market is back. But beware. If inflation hasn't truly died, the cut is gasoline on embers. Ordinary Americans get a short-term break on payments, then find food, fuel, and rent climbing again. Investors ride a sugar high, then slam into a wall. Long-duration bonds? They rally, then whipsaw violently if inflation expectations return. Relief? Yes, but deceptive relief. Scenario 2. The Fed holds. This is the tightrope. Powell buys time, hoping disinflation drifts lower on its own, but the earthquake still shakes beneath. Corporates bleed from higher interest costs. Small businesses delay expansion. Equity markets grind sideways. Speculative bubbles deflate quietly. Winners: companies with fortress balance sheets and hard cash. Losers: fragile, over-leveraged firms promising profits someday. The silence feels safe until the first crack appears. Scenario 3. The Fed hikes again. The nuclear button. Markets scream. Yields soar. Multiples collapse. Credit freezes. But it crushes inflation expectations like a sledgehammer. Think of it as pulling a tooth without anesthesia. Brutal in the moment, decisive long-term. Recession odds jump over 70%. Unemployment climbs. Yet for patient investors, this is often how fortunes are made, by buying the panic others can't stomach. Now pause. If you think those scenarios sound rough, wait until you see the global dominoes they set off. The Fed doesn't just steer America, it sets the pulse of global money. When the Fed hikes, capital rushes into dollars. Emerging markets bleed, their currencies sink, their debt service explodes. In Europe and Japan, central banks face a cruel choice: follow the Fed to defend their currencies, or watch them collapse. Commodities like oil, copper, gold, and silver, all priced in dollars, move not just on supply and demand, but on the greenback's gravitational pull. Sometimes a strong dollar smashes commodity prices, sometimes it triggers supply cuts and chaos. Either way, the Fed's move echoes far beyond Washington. History has been brutal here. In 1994, a rapid tightening blindsided bond markets. In 2013, just hinting at slowing bond buying sparked a taper tantrum across emerging markets. In 2019, dollar funding markets froze so fast the Fed had to rescue its own plumbing. In 2022, a spike in yields nearly broke the UK pension system. Different costumes, same play. When liquidity thins and leverage hides, something breaks where no one is looking. So what happens when it breaks next time? Maybe it's a private credit fund that grew too fast in the shadows. Maybe it's a regional bank mismatched on duration. Maybe it's a sovereign balance sheet caught off guard. You don't need to predict the fuse. You need to know where the exits are. But numbers alone don't keep you watching. Stories do. Meet Sarah Miller, a 37-year-old who runs a family furniture business in Ohio. In the easy money years, she borrowed cheap to expand. New machines, better warehouse, a team of skilled workers. Orders from national retailers poured in. She felt unstoppable. Fast forward to today. Higher rates inflate her loan payments. Customers delay reorders. Her friendly bank starts tightening covenants. Sarah isn't watching CNBC for fun. She's awake at 2 a.m. with payroll stress, staring at spreadsheets, whispering, "Do I cut staff? Do I carry this debt another quarter? Or do I raise prices and risk losing clients?" The Fed's policy isn't abstract to her. It's personal. Now meet Mark Johnson, CFO of a mid-cap logistics company in Chicago. In the low-rate era, Mark was a hero. Refinance cheap, extend maturities, buy back stock, juice EPS. Shareholders loved him. Today, his playbook backfires. Debt is rolling over. If the Fed holds, he bleeds slowly. If it cuts too soon and inflation reignites, fuel and labor eat him alive. If it hikes, his interest bill explodes, covenants snap, and one downgrade shoves his company into junk territory overnight. Mark isn't just fighting the Fed, he's fighting the math of survival. Sarah and Mark aren't hedge funds, they're Main Street. And their pain is why Fed policy is never just numbers, it's people. So what is smart money doing while Main Street sweats? Hedge funds hedge. They buy volatility cheap, go long gold, short treasuries, play both sides. Corporates lock in financing now before the window slams shut. Governments quietly stockpile reserves. But the smartest strategy isn't copying them. It's building your own survival kit. Here's the 3-step playbook I promised at the start. 1. Respect liquidity. Cash isn't dead money, it's oxygen. It lets you say yes when everyone else gasps. 2. Diversify by type, not ticker. Don't just own more stocks, mix assets that react differently to growth, inflation, and rates. 3. Pre-write your if-then rules. If the Fed cuts, I'll add to quality growth. If the Fed holds, I'll tilt to fortress cash flow. If the Fed hikes, I'll buy panic in thirds, not all at once. These 3 rules turn fear into a framework. Housing makes it personal for every American. A home isn't a trade, it's life leverage. When mortgage rates jump, transactions freeze before prices fall. Sellers cling to old comps, buyers to monthly payment math. If the Fed cuts modestly, volumes recover even without price spikes. If it holds, the freeze drags on. And roofers, contractors, landscapers, and yes, Sarah's furniture shop feel the pain. If it hikes, affordability cracks, prices fall faster, and forced sellers appear. Want signals to track in the next 90 days? Watch these 5. Core inflation versus wage growth, the slope of the yield curve, credit spreads in high yield and leveraged loans, the dollar versus major peers, and the balance between quantitative tightening and Treasury's cash account. Those 5 indicators are like the dashboard lights in your car. Ignore them, and you only notice the smoke when the engine's already on fire. Before we wrap, let's go one layer deeper, because what actually pushes markets over the edge isn't a single rate move. It's the feedback loops that follow. Think of 3 flywheels: liquidity, confidence, and collateral. When the Fed tightens while Treasury issuance is heavy and the balance sheet is shrinking, liquidity thins. Thinner liquidity pressures asset prices, falling prices dent confidence, and dented confidence makes lenders demand more collateral or refuse credit altogether. That's how a policy choice becomes a market event, and a market event becomes an economy event. Start with real yields and break-even inflation. If real yields keep marching higher while break-even stall, the discount rate crushing future cash flows gets heavier by the day. That's why a basket of Profits Tomorrow names can drop 20%, while cash now businesses barely budge. The catch: if the Fed blinks and real yields fall faster than growth expectations, the seesaw flips, duration assets run, value lags. You don't have to guess. You watch the spread between real yields and earnings revisions. If revisions are falling while real yields rise, risk wants a wider risk premium. Avoid hero trades. Now zoom into credit. The first cracks rarely shout. They whisper through refinancing windows and covenant tweaks. Meet Alyssa Chen, who runs a 14-location quick-service restaurant chain in North Carolina. Her floating rate credit line went from 4% to 9%. Food input stabilized, but her interest expense doubled. Her choice: pause new stores, renegotiate the lease on a weak site, and move to weekly cash forecasting. She isn't bearish, she's protecting oxygen. Meanwhile, Derek Walsh, who owns 180 rental units in Tampa with variable rate bridge financing, faces an interest reset. If the Fed holds, he survives, barely. If it hikes, cap rates reprice and appraisals fall just as his lender asks for fresh equity. Same macro, different balance sheets, very different outcomes. Confidence is the second flywheel. Jasmine Patel, an ICU nurse in Phoenix, doesn't trade, but she does decide whether to buy a home and keep contributing to her 401k when mortgage quotes jump from 5.5% to 7.25%. Her monthly payment math breaks. She defers the purchase, funnels more into cash-like options, and postpones a big-ticket car. Multiply Jasmine's choice by 1 million households, and you get a demand air pocket without a single company announcing layoffs. That's how policy tightens even when the unemployment rate still looks fine. Collateral is the third flywheel. Ask Ethan Brooks, a 32-year-old software engineer in Austin whose stock comp heavy net worth is tied to one mid-cap tech employer. When his company's multiple compresses from 18x to 12x because real yields jumped, his collateral for a planned mortgage feels smaller overnight. He wasn't forced to delever until he was. Now imagine the same dynamic in private markets where marks adjust slowly. When lenders finally reappraise, the surprise feels like a shock, even though the math was visible for months. Let's make the toolkit sharper. A practical approach is a barbell. On one side, fortress cash flow names with pricing power and low net debt. On the other, a small rules-based sleeve of high-duration winners you only add to when two conditions align: real yields falling and earnings revisions turning up. In between sits a core satellite bond mix, short duration for ballast, plus a tactical sleeve you only extend when the term premium compensates you. Layer a tiny allocation to anti-currency hedges that you rebalance, not worship. And write position sizing rules in ink. No single idea greater than 3% at cost. No single theme greater than 15%. Max portfolio drawdown target 10 to 12% with preset de-risking steps at -5% and -8%. Rules beat vibes. Signals worth adding to your dashboard. The term premium. When it jumps, long bonds can sell off even if cuts are priced. Jolts openings versus quits. Softening labor power eases wage pressure. And the NFIB Small Business Survey, credit conditions and pricing plans here lead Main Street behavior. Also, watch GS/BOA financial conditions indices or their rough equivalents. When they tighten quickly, risk assets usually wobble a few weeks later. Finally, understand why soft landings are so rare. It's not incompetence, it's inertia. Prices and wages move with lags. Contracts reset quarterly or yearly. Psychology changes suddenly. The Fed is piloting a supertanker into a narrow harbor at night with crosswinds. If you accept that, you stop seeking perfection and start practicing calibration. Smaller, earlier moves, staged entries, rebalancing on volatility, not headlines. Which brings us back to people. Sarah Miller decided to hedge part of her rate exposure with a capped swap and trimmed SKUs to free working capital. Her on-time delivery rose, cancellations fell. Mark Johnson ate a painful refinance 2 quarters early, suspended buybacks and pre-funded CAPEX at a rate he hates but can live with. Alyssa made peace with slower unit growth to keep her staff intact for the rebound. Those choices don't trend on X. They keep companies alive. Survival is a strategy. If there's one meta rule, it's this: don't predict the next headline. Pre-commit your next action. If real yields drop and the curve steepens bullishly, you add measured duration and quality growth. If spreads widen and liquidity drains, you raise cash from your weakest convictions first. If volatility spikes, you buy in thirds and set resting bids. When the feed fills with panic or euphoria, you already know what to do because you wrote it down when you were calm. And here's the bottom line. The Fed is trapped, cut, hold, or hike. Someone bleeds. Bondholders, homeowners, over-leveraged companies, maybe even governments. But it doesn't have to be you. Knowledge is leverage. Preparation is power. And right now, you have both. If this breakdown gave you clarity, hit subscribe, tap the bell icon, and like this video because markets punish the uninformed but reward the prepared. Share it with someone who's panicking about headlines and give them a playbook instead. Read the signals. Own the game. The Fed's next move won't just move markets, it could break them. Your job is to be ready when it does.